Welcome to the course titled Accounting for Business Combinations. My name is Kellan Camille. This course provides an overview of the accounting and reporting requirements related to business combinations as outlined in ASC Topic 805. The objective of the guidance is to improve the relevance and comparability of information that an entity provides about business combinations. Our learning objectives for this course is to identify the definition of a business, list the steps involved in the acquisition method, and identify the acquisition date. Additionally, we'll also address how to measure goodwill, the measurement period, as well as some of the financial statement disclosures required by GAAP. Entities that engage in business combinations are often faced with several financial reporting issues. One of these issues is determining whether a transaction represents a business combination or simply an asset acquisition. Another consideration is how to account for the consideration transferred, as well as measuring and recognizing the fair value of assets acquired and liabilities assumed. Let's start at the beginning, though, and better understand what a business combination is. The GAAP definition is that a business combination is a transaction or event in which an acquirer obtains control of one or more businesses. An example of this could be a true merger or even a merger of equals. We know that a business combination includes the acquisition of a business. To understand what a business is, we again have to look to ASC 805 for that definition. As noted here on the slide, a business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing any one of the three things. This could either be dividends, lower costs, or other economic benefits directly to its stakeholders. It's important to distinguish between an asset acquisition and a business combination. These two paths have very different reporting impacts. You should note that ASC 805 includes a screen to determine if a set of assets or activities represents a business. In fact, if substantially all of the fair value is concentrated in a single identifiable asset or group of similar assets, it's not a business. When this occurs, it's treated as an acquisition of assets and not a business combination. Because it's important to have a strong understanding of what is considered a business, let's look at this concept a bit further. A business consists of inputs and processes that can create outputs. The point here is that it can create outputs, but doesn't necessarily have to in order to qualify as a business. On this slide, we have some examples of inputs, processes, and outputs. Inputs are economic resources that create or have the ability to create outputs when one or more processes are applied to it. Assets and IP are examples of inputs. Processes are systems, standards, or protocols that when applied to inputs, creates or has the ability to create outputs. Operational processes are a good example of this. And finally, outputs are a result of what happens when you apply a process to certain inputs. Again, this can be in the form of dividends and other economic benefits. Again, recall that a business does not necessarily have to have outputs. However, there is an important point to note here. If the business does not have outputs, it must have an organized workforce that is made up of employees in order to qualify as a business. If a particular set of activities has goodwill, it is generally presumed to be a business. However, a set of activities that is concluded to be a business does not necessarily have to have goodwill. The FASB has also clarified here that there should be more than an insignificant amount of goodwill, though, to support this conclusion. In other words, the mere presence of goodwill is not enough to represent a business on its own. Instead, having more than an insignificant amount of goodwill is a good indicator. When accounting for a business combination, ASC 805 requires the use of the acquisition method. Many years back, the FASB used the term purchase method to describe the process. This change was based on the fact that a business combination can occur in the absence of a purchase of net assets or equity interests. There are 4 steps to the acquisition method. The first 2 steps involve identifying the acquirer as well as the acquisition date. The third step is likely the most time-consuming. This is where the assets and liabilities are actually measured and recorded. This step also involves the consideration of any non-controlling interest. The final step in the process involves either recording goodwill or a bargain purchase. We'll discuss each of these steps in more detail in the following slides. Step 1 involves identifying the acquirer in the transaction. The principle here is easy. The entity that obtains control of the other party is often concluded to be the acquirer. At the risk of stating the obvious, one of the entities is required to be identified as the acquirer for every business combination. When identifying the acquirer, the consolidations guidance outlined in ASC 810 should be considered first. The usual condition for a controlling financial interest is having ownership of a majority of the voting interest. For example, if Entity A has 75% of the voting power after a business combination with Entity B, Entity A would be the acquirer. Generally, if ownership by one entity is more than 50% of the outstanding voting shares of the combined entity, this determination is pretty easy. However, there may be times when control can exist with a lesser percentage. In some situations, the assessment of who has a controlling financial interest may not be a simple conclusion. In this situation, an entity should often look to certain factors outlined within the implementation guidance of ASC 805. But first, if the business combination includes the acquisition of a variable interest entity, the primary beneficiary will always be the acquirer. As you may know, the primary beneficiary is the entity with both the power and benefits of the VIE. If the business combination does not involve a VIE, then you should look to other factors to help make the determination. Relative voting rights is one of the first areas to consider. The acquirer usually is the entity whose owners collectively retain or receive the largest portion of the voting rights in the combined entity. There may be times that you also look at the composition of the governing body and even senior management. In these situations, the acquirer usually is the entity whose former management dominates the management of the combined entity. For a business combination that is effected primarily through the transfer of cash or other assets, the acquirer is usually the entity that transfers the cash or other assets. However, for a business combination that involves the exchange of equity interests, the acquirer would normally be the entity which issues its equity interests. There may be times when you've evaluated all the preceding factors and still can't conclude on who is the acquirer. In this situation, the FASB notes that it's generally safe to assume that the acquirer usually is the entity whose relative size is significantly larger. When we say relative size, we're talking about things such as assets, revenues, and earnings. Another consideration at this point would be to consider which entity actually initiated the transaction. And finally, you should note that a newly formed entity established for the purpose of affecting the business combination will not necessarily be the acquirer. In this situation, the FASB notes that if a new entity is formed to issue equity interest in the transaction, one of the entities that existed before the business combination should be the acquirer. Once you have identified the acquirer, you need to next identify the acquisition date. The acquisition date is the date when the acquirer obtains control of the acquiree. This is generally the date when the acquirer legally transfers the consideration, acquires the assets, and assumes the liabilities. In other words, this is generally considered the closing date of the transaction. There may be situations when control is either obtained earlier or later than the closing date. One situation when the acquisition date precedes the closing date is if a written agreement provides that the acquirer obtains control of the acquiree before the actual closing date. Even though the acquisition date is generally easy to determine, entities should always consider all the relevant facts and circumstances when concluding on the acquisition date. In this slide, we've also provided a few excerpts from EY's Guide on Business Combinations. You'll note that one of the issues addressed relates to a business combination that may require regulatory or shareholder approval. In these situations, the firm believes that control cannot be obtained until that approval is obtained. Once the acquirer and the acquisition date has been identified, the next step in the acquisition method relates to actually recognizing and measuring the assets, liabilities, and non-controlling interests. This is because ASC 805 notes that obtaining control is a new basis recognition event. the assets acquired and liabilities assumed, including any non-controlling interests, are recognized at 100% of their fair value. However, there are some limited exceptions to this overall principle. In order to qualify for recognition, there are two recognition conditions that must be met. For starters, the assets acquired and liabilities assumed must meet the definition of assets and liabilities included in the FASB concept statements. Secondly, the assets acquired and liabilities assumed must be part of what the acquirer and the acquiree exchanged in the business combination transactions. In other words, if assets were exchanged in a separate transaction, these would not be within the scope of the business combination. The second condition can sometimes be challenging. In some situations, the parties to a business combination have a pre-existing relationship before negotiations for the business combination began, or they may enter into an arrangement during the negotiations that is separate from the business combination. In either situation, the acquirer is required to identify amounts that are not part of the business combination. For these amounts, they are accounted for in accordance with other applicable GAAP.